sure what's if we do some disposing of assets, it might be a little bit lengthy towards the end. Okay, so we will see. Regardless, it's still Monday. Okay, this is the first time I've done it all in one day. We'll see how it goes. Some people I don't think are doing it until Sunday anyway, which is fine. But this way I can go ahead and get it all done. And if you have trouble, you can contact me earlier in the week, so later in the week, we can get it all worked out. We have a private session if we need to. Let me know. But anyway, so chapter 10, we're going to do the quick study real quick. And, well, I say real quick, it might take a long time. It might take 20 minutes. So who knows? I got my sodas, Coke Zero. It's good stuff. Okay. So here we go. January 1st. Not the Dave Matthews Band, just the Matthews Band, okay? If you don't want to get any sort of trademark things. Okay, the Matthews Band pays $65,800 for equipment. So that's the cost. It tells you the cost right away. Okay, so we've got a cost. Let's go ahead and write on a little board here. We got a cost. $65,800. Okay, what else we got? We've got life. Okay, so we got a life. Estimates it will use equipment for 4 years. So the life in years is 4. All right. Then it says the life. It's either going to last for 4 years and 200 concerts. So the life in units, in this case the units are going to be concerts, is 200 concerts. Kind of a weird unit, but that's how it would be for sound equipment for a band, right? Makes kind of sense. And it says after 4 years it can sell the equipment for $2,000. Okay, so that's salvage value. So our salvage value $2,000. Okay, there's one last piece of information. It says year 1, the 45 concerts. We don't need that right now. So on my board, I've got all the information. Okay, I've got the cost. Okay, I'm trying to get squared up, kind of good, framed up. Okay, right about there. The cost is $65,800. Okay, the useful life is 4 years. In terms of years, the useful life in essentially units would be 200 concerts. The salvage value is $2,000. And if I need it, year 1 we did 45 concerts, okay? Now the first question here is, well, what's the straight line depreciation? So for straight line depreciation, we don't need this. Oh, I just wiped it off, didn't I? Well, there you go. It feels like I'm reversed on my screen. So right here, we don't need the life in terms of concerts. And we also don't need the year 1 concerts, okay? But we do need cost, we do need salvage value, and we need life in years. So again, here's our formulas here. I got them typed up in Excel now. Okay, so the straight line method, cost minus salvage divided by life in years. Nice and easy, okay? So if I go to our problem, go back to, where you go, Google. All right, our numerator is going to be cost minus salvage. Denominator is life in years, okay? Estimated useful life in years, okay? Which is 4, okay? Now I've got to go ahead and do the math for the top part myself. Remember, it's cost minus salvage. Here we go. So my cost is $65,800, right? We're going to subtract from it $2,000. Okay. So my depreciable base or cost by salvage is $63,800. Okay, divide that by 4. 15,950. Oh, wait a minute. I just did that wrong. This is for 15,950 there. So each year for 4 years, we will depreciate $15,950. Quick check. Boom. Okay? Nice and easy. So there's number 1. Move on to number 2. So, same problem, but what if we do units of production? Okay? What if we do units of production? So, when you do a units of production method, you're going to figure out the depreciation, not for a year, but the depreciation for 1 unit. Okay? And then you got to multiply it by the number of units you do in the first year. All right, now. So from the board, we got the cost. We'll need that. We don't need the 4 years this time, but we need to know it's 200 concerts. And we need to know the salvage value again. And we also are going to need that year 1 concert down here as well, which is 45. Okay. Select. It says to select the formula. Okay, the formula is on my Excel spreadsheet. Cost minus salvage value divided by the units of production, or the life in units. Here we go. So there are some scary ones here, but the one, okay, so but it can only be the first 3, right? DDB rate, we didn't even talk about that. So this is salvage value. It's highlighted now, but this here is my units of production, which is life in units. Okay, is what I called it on my board. Okay, or my spreadsheet. So it's cost minus salvage value divided by the units of production. In this case, it's going to be the concerts. All right, let's get my calculator back out. All right. Again, cost is $65,800, right? Minus the salvage value of $2,000 will be that $63,800. So we're going to divide that by the 200 concerts. It's either going to last for 4 years or 200 concerts. So we're going to divide it by 200 concerts. Okay? So $319 is the amount of depreciation, or essentially it's the estimated amount of value these speakers lose, or this sound equipment loses after a concert, just from regular wear and tear. Okay? So the depreciation per concert is $319. Okay? Right here it tells you during the first year they performed 45 concerts. So the first year concerts is 45. And it does the math for us. Okay? There it is. Okay. Excuse me. Alright. Good. Quick check on my work, but I know it's right. Okay. Score it. Number 3. Okay. So, this one's different. This one is filling out the chart. And it says to do it for, this is an 8-year chart, but I'm only have to do it for what? 3 years? Okay, easy enough. So we've got cost. You see it, $830,000. Okay, so our cost is $830,000. Okay, I'm thinking about straight line right now. Okay, so because this is going to be a double declining, it's a double straight line essentially, double declining balance method. So let's figure out the rate of straight line depreciation. So we got $830,000. Okay, and we're going to subtract from it the salvage value of $75,000. And this is going to be a 8-year life. Okay, so this entire amount here, which is, I don't know, 700 something, right? I don't care what it is. This entire amount, or 100% of it, so 100% of the numerator will be depreciated over 8 years if we're doing the straight line method. If we're doing a straight line method, 100% of this $700 some odd thousand will be depreciated over 8 years. What's that, 12.5%? Ugh. 12.5. So the straight line depreciation rate, there we go, 12.5%. That's normal straight line method. We will depreciate 12.5% every year for 8 years, and that will equal the entire numerator, which is cost minus salvage. Okay? In the double declining balance method, we'll double that straight line rate. So instead of doing 12.5%, we'll do 12.5 times 2, which is 25%. Okay, so this 25% will be our rate of depreciation. Okay? All right. So let's fill out the first line, and I'm going to go to my Excel chart and do the whole daggum thing. Okay? So my beginning of the period book value is not cost minus salvage, it's just cost. Okay? This is the trickiest part of straight line depreciation. Make sure you use cost, not cost minus salvage, for your first year beginning book balance. Okay? $830,000. Remember that rate is 25%. And so the depreciation expense in that first year is $830,000 times 0.25. Okay. 207,500. All right. It's doing the rest for me. Great. Let's go to my chart, though. My Excel chart. Now, I do see that I have these flipped to my chart, so be careful when you look into my chart that the book, this problem has the book value outside of depreciation. I've accumulated, and on my chart you'll see here, I get any book value here and accumulate out over here. All right, let's yeah, sure, real quick, insert. All right. Year 7. All right. I'm going to blank all this out. Okay, so what's our cost again? $830,000, $75,000. Blah, 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 blah. I hit no block. Okay, remember our rate is 25%, and that's going to be for every year, even that last year. All right. So remember, the cost is going to be $830. This end book value is going to be $75. Okay, but let's leave that blank. We'll come back to that when we get to it. Okay. Now, the depreciation expense will always be the book value times the rate. Okay, so it's going to be $830 times. Okay, and there's that 207,500, which you see I already put in right there. Okay. So accumulated depreciation is going to be that amount for the first year. It's going to change after that, right? Our ending book value will be the book value minus the depreciation expense for the year. Lovely. All right. So year 2, our book value is going to start off with our ending book value from year 1. We will do the book value times the 25%. And then we will subtract those two to figure out our ending book value minus this. Our accumulated depreciation is going to be the previous year depreciation minus the current year, plus the current year depreciation. There we go. All right. Let's do one more year. We'll fill it in. We'll fill it in on the quick study, and then we'll fill out the rest of the chart real quick. Okay, so year 3 starts out with that number. We're going to multiply it times 25%. Ending book value. Accumulated depreciation. Oh, hang on. Previous year. Previous year plus current year. All right. Let's see if I can do this. So second year book value, I got it right there, right? 622,500. Okay. Depreciation expense 155,625. 155,625. And it's 25% is the rate. The rate is not going to change, right? So let's go back to Excel and look. Okay. My accumulated depreciation is over here. 363,125. My book value is 466,875. So it looks good. So we'll put that 466,875 here. 466,875 right there. And does it say it says to round to the nearest dollar? So we will do 116719, right? 116. Okay. And let's check out my last two numbers again. So my book value, you see right there, 350,156. And my accumulated 47984 rounded up to 4. Okay, perfect. Real quick to finish this out, remember the good thing about this is if you're good at Excel, it makes it super easy, is we can automate, right? So because we've got this formula is the previous year's book, okay, we can just extend these all downward, right? Look at this. Okay. If we were going to do this to make it proper, we would have to force this here at the end. Okay, because this has to equal $75,000. Okay, so what we would do, let's figure it out, right? Real quick. .63 minus the 75. So this last year we would actually do a little bit more to make it work. So this last year we would actually, instead of doing 27, we would do 35,791.63. And now you see how it works a little cleaner. But anyway, we ain't gonna do all that. But that's what Excel can do if you know how to set these things up. It can do all the work for you, right? It's a great thing about Excel. Anyway, I wasted too long on that problem. Let's keep moving forward. Quick checking my work. Okay. Okay. Wind turbines, straight line method, October. Okay, so this one here's this doesn't have a January 1st or beginning of period due date. So the first year we will only do partial depreciation for the amount that we had in that first year. That's the hard part about this. Otherwise, it's a straight line method. Okay, so to figure this out, the first year. Well, let's just figure out straight line method first. Okay, so the straight line method is going to be $140,000, which is the cost. The salvage value is 20, and the useful life is 6 years. Right, so this is years. These are monies. Okay, so it's going to be what, 120 divided by 6 years. So it's $20,000 a year is depreciation, right? Okay. The depreciation is $20,000 per year. Okay. But the difference here is here we purchased it October 1st. Okay. We didn't purchase it January 1st. We purchased it October 1st. So we only want to depreciate 3 months. Okay. So that first year's depreciation, year one, is going to be that $20,000 times, well, let's see, October, November, December. So 3 out of 12, right? So that's going to be your calculation. Okay, so year one, you'd get $20,000 times 3/12. Now, year two is a full year, so it'll just be, $20,000 times 12/12 or 1. Okay, but that first year, we will do $20,000, okay, times 3 divided by 12, which is a fourth. So we divide by 4. Hang on, I messed up. Yeah, so it's $5,000, right? So year one's $5,000. Year two will be a whole year, $20,000. Remember, when you do it like this, I have to remember, what's going to happen here? Oh, you know what? It's 6 years. What's going to happen here is there will actually be some depreciation in a 7th year, okay? Even though it's a 6-year life, it's going to stretch over 7 periods or 7 years. Okay, so in year one, we'll do 3/12. Years 3, 4, 5, and 6 will be full depreciation. Then year 7 will pick up the other 9 months that we didn't pick up in year one. Okay, and that's what I want to focus on. All right. There's that one. And then finally we come to here. So this is arguably the hardest one. Okay, it's dealing with dispositioning, getting rid of assets. Okay. All right. So the first thing we got to do. Okay. Let's use Excel to help us with this problem too. Okay. Okay. We have you know what? Equipment. Okay, so equipment. Let's draw the T's on the board. Okay, so we're gonna have like cash. Equipment. Yeah, this is going to be a long one too, right? Nothing can be short in accounting, evidently. Accumulated depreciation. So here are the T's that we'll use. Cash, the equipment account, the accumulated depreciation account, gain on sale, loss on sale. Okay, really it's gain on sale of assets, loss on sale of assets. For the bottom two, gain is a revenue, so it'll be a credit balance. Loss is like an expense, so there'll be a debit balance. Okay, so cash, equipment, accumulated depreciation, gain on sale, which is a revenue account, loss on sale, which is essentially the expense account. Now, it gives us our cost. Okay, our cost for the equipment is $76,800, and it tells us that the accumulated depreciation is $40,800. There's a dog drinking. You might hear him. Okay, equipment's an asset. It should be a debit on the debit side. Accumulated depreciation is a contra asset. It should be on the credit side, right? Okay, so what we have to do here in order to calculate gains or losses is to figure out the book value. Okay, so we'll do that here so our book value is a calculation. We got a book. So here's the formula: cost minus accumulated depreciation. Doesn't like it. Let's change it to format this cell to be text. Book value. So here's our formulas. Let's make it look pretty. Cost minus accumulated depreciation. And I should probably call this here like historic cost. Let's put a space in there. Not there though. Okay. So for this problem, we have let's make this big again. I don't need the top anymore. We have a historical cost right here of $76,800. $76,800. We have an accumulated depreciation is $40,800. And now I got to find the difference. Okay, so it's going to be the top one minus the second one, the $40,800. So let's make this look like monies. Accounting, no decimals. Okay. So you got the cost minus the accumulated depreciation leaves us with a book value of $36,000. Now, to figure out the gain or loss, we have to figure out the cash collected. Okay. And subtract the book value. I knew it was going to do that. Text again. Get rid of the equal sign at the beginning. Okay. And underline. This will be gain. Now watch this. If it's negative, it'll be a loss. Okay. So we got three transactions. We got A, we got B, and we got C over here. Okay. Book value is never going to change. Okay, these are all the same. Okay, but the cash is different in each problem. So the first one is if we got 47,000 cash. The second one 36 and then 31. Okay, so I forgot the number already. 41. 47, 36, 31. 47, 36, 31. Let's make these all look fancy like numbers, counting, no decimals, using dollar signs. Okay, let's get extend an underline. Now, so in the first one, we collected $47,000, but the asset's worth in our books $36,000. If you sell it for $47,000 and what it's worth to you is $36,000, and obviously there's a gain in there, right? You're selling it for more than it's worth. That's a good thing. Okay, so to calculate that gain, we'll do the cash collected minus the book value. $11,000 gain. Okay. The second time we sold it for book value, so there's no gain here, right? So it's the cash collected minus the book value. And the last one over here, we sold it for $31,000. We sold it for less than book value. So the calculation again is cash collected minus the book value, negative $5,000. That's a loss, right? So it's a loss because it's in parentheses. Okay, so that's our gain and loss for these entries. Now, for all of these entries, okay, we have to record two things that we have to do in each entry, okay? We have to get rid of the equipment by doing a credit for $76,800. We must also do a debit to accumulated for that amount. Okay, so in all of these, this and this is required as part of the journal entry. Okay, both of those are required in the journal entry. A debit to accumulated depreciation, because we got to zero this stuff out, right? Because we're disposing of them, they're getting sold. So we have to remove accumulated by doing a debit and equipment by doing a credit for their full amounts. Okay. Remember that as we do the entries. Okay. So let's come back to our entry here. Okay. Excuse me. We sold it for $47,000 cash. We received the cash. The first thing we should go ahead and do is show the amount of cash coming in as a debit. Okay. So the very first thing I want to do here is do a cash debit of $47,000. Okay, if you want to see it on the board, that's fine. $47,000. And then another zero. Okay, so there it is. Cash debit, $47,000. All right. The next thing we got to do is over here, accumulated depreciation, do the debit, okay? Do that $40,800 debit to accumulated next. Okay, accumulated. Okay? Now, remember, in this case, okay, we've calculated already. So we know that there's a gain of $11,000. And that has to be a credit. Okay? So I have to do an $11,000 credit here. And I can't forget that credit to equipment of the cost of equipment. Then that should be done. Okay? Where's my pen top at? Did I lose it already? Oh, here it is. Okay. Excuse me. All right. So two credits here. One is the gain of $11,000. That's not $11,000. And then also we have to get rid of the equipment. And that's at this cost. $76,800. Now, if you do this math, it should work out just fine. It looks good based off of iCheck, okay? So that's the first entry. B is when we sell it for no gain or loss, okay? So we have the cash coming in. In this case, it's $36,000. Okay. We also have to do the entry, if you want to go back and look at it. The next thing is accumulated depreciation. Okay. So that'll be the same, accumulated depreciation. Then the last thing we got to do is to write off the equipment at cost. $76,800. There is no gain or loss. And so when you look at this, if you add these two guys together, you'll see that they do actually, in fact, equal that equipment. There's no gain or loss to record. We're done. Okay? So let's go to the last one. Which is where we have $31,000 in cash and a $5,000 loss. Okay, so here when we do that one, we'll have $31,000 coming into the cash account. We still have to do the debit to accumulated depreciation. We still have to do the credit to equipment. But we also have to do a loss, and the loss goes on the debit side because it's like an expense. So we'll do that $5,000 debit here. So the order should really be 1, 2, 3, and then 4 here because the credit goes last. Okay, let's key it in, and then we'll wrap it up. Okay. So C, we got the cash coming in of $31,000. We got the accumulated coming off the books at $40,800. We got to record the loss on the sale. Loss on sale of equipment of $5,000. And then finally, we can get rid of the equipment at a cost of $76,800. Okay. You might have to go through that a few times to get the hang of it. But that's the process. It's not too bad once you do it a few times. What's key here is you always have the debit to accumulated depreciation and the credit to equipment. The cash is given to you, so the other piece of that puzzle is the gain or loss, if there is one, okay? Complete and correct. Okay? Complete and correct. All right. So we are ready for our last question in the chapter. We're at the tail end here. So week 4, question 2. Now this might be where it doesn't apply. Some of you guys, it might be too cool for this, right? But I want to know what your favorite musical is, okay? It's not musician, not singer, but actual musical, okay? And I would say mine's probably like Grease and Grease 2. That's kind of my heyday. Back when I was a little kid, remember we would have the 8-track tape of the Grease soundtrack, and we would try to do concerts in the family room with all our cousins and stuff. It was a big time. So definitely Grease and Grease 2 is my favorite. So give me your favorite musical. Okay, if it has to be a cartoon, I would say probably something like a, Beauty and the Beast, Little Mermaid, Lion King. Those all had a lot of music in them. You can probably count those. Some of you guys are too cool to have a real musical, right? So anyway, that's your question for the week. Second question for the week. Get this stuff done. It should be due on Sunday night. And remember, do your old work if you need to. Contact me for help if you need it. And we'll make it happen, guys. We got to get this. We got to get through this. Some of you guys are on a great trajectory. Some of you guys are a little behind. We got to get caught up, guys. God bless you. If you don't hear anything else, I'll be back Monday to do the last chapter, okay, which is chapter 11. Okay. Again, God bless. Have a great week. Contact me if you need it. These will be on YouTube shortly, and I'll post to the Blackboard. We'll see you soon.